technically start until 2:30. But if we have Bloomberg on, we'll be able to see when the exact announcement's made because it's imminent of what this rate decision is going to be. So if you are watching, please do me a solace. Hit that like button. It would really do a lot of good for me. It'll allow this to push through and we can get a bigger audience. So we'll see if we do push down like for XCC to 382, if it holds the structure, if we do break down a little bit, but hold it overall and then end up breaking out afterwards. But let's see what the decision is. Anybody in here, I welcome you in. We'll see if we get volatility upside or downside. It's sure to be volatile. It's sure to be volatile here. There's no doubt about that. Metals right now, silver's down to 111. Could be a sign of things staying the same if it continues. And I don't know if we would have a meltdown in crypto or what if the rate stayed the same, but we'll see. Let's listen to what they're saying.
The new Fed chair going on to the committee, nominated by this White House, entertaining a conversation at the end of the year about interest rate hikes.
Well, that's why that is such a difficult thing, because that person has to go in together with the other voting members. There are 12 voting members in total. This is just one vote.
We're waiting for the imminent decision, everybody. It's imminent within the next minute or so.
The inflation outlook, and therefore that will be definitely data dependent and data driven.
What do we think in the comments? Lower rates stay the same.
Temporary, transitory. What is the reason why inflation continues to be so sticky? Which is what the consensus continues to expect.
Just imagine the drama down at the nation's capital in Washington, D.C. if any of that materializes. Torsten Slock of Apollo is going to stick with us. The decision is about 45 seconds away. The equity market is just off all-time highs.
About 45 seconds away.
So far this year, we have had tremendous outperformance on the Russell.
So we got about 45 seconds left here.
The Nasdaq up by 0.4%. The attention turns to the Nasdaq a little bit later.
If they raise rates, it's going to be very interesting, and this could be a black swan event for gold and silver if that happens.
Anchored around 350 to 360, 358. Yields up by not even a basis point on 10s of 425.
It seems like it's going to stay the same, but you know.
The drama, the fireworks and headlines have been in the FX market.
It's interesting. Based on what the crypto market's doing, it's not excited. Gold and... Here we go. Oh, shit.
The expectation with the call.
Expected, John. No change in rates, and the Fed leaves open the option of cutting rates in the future. Stephen Meyer,
they stayed the same.
Dissent in favor of a rate cut. Michelle Bowman does not. Waller's dissent, of course, could be read as an...
No, they didn't even cut it. Guys, it's not even a lousy 25. They didn't cut it at all. They didn't cut it at all. This is what we were saying. That it likely was going to stay the same this time, which is crazy.
Suggesting more rate cuts are possible. There's no hint, however, of what that would lead them to do that or when. The economic assessment is very short and relative to recent stations, slightly positive. Available indicators suggest that economic activity has been expanding at a solid pace, it says. Job gains have remained low, and the unemployment rate has shown some signs of stabilization. Inflation remains somewhat elevated. The officials say uncertainty about the economic outlook remains elevated, but they don't emphasize jobs.
I'd be very careful right now with crypto. Last time we even got a 25 base point rate cut, we dumped after about an hour.
The risks to both sides of its dual mandate, the statement says. The open market desk at the New York Fed is again told to maintain an ample level of reserves by buying treasury bills or, if necessary, maturity.
You want happy, listen.
It's all about as plain vanilla as you can get.
Guys, you have zero understanding if you think any of this right now has anything to do with crypto at this point. You have to wait till what Jerome Powell says at 2:30 to see if he's hawkish or dovish. That's where all the details are. Initially, you would expect crypto to dump, and then if he says something hawkish or dovish, it'll design where we're going to go. But initially, this is horrible. Last time crypto, we got a 25 base point rate cut and it dumped. This time we didn't even get a rate cut. I can't imagine this is going to bold well. A short term we can go up. Short term, a lot of times we move up. But I can't imagine, even short term we might not. This might not be good. Gold and silver, even with it staying the same, you could start seeing a topping event start taking place. Like the miners reverse now. And they're down. You know, I'm not actually surprised to see this, if I'm being honest. Staying the same though is the equivalent of I don't know, for crypto, it's not good. Let's hear what they're saying.
Shifts the focus, of course, to Chairman Powell's news conference at the bottom of the hour. What does he say about the future of interest rates? And what does he say about his future as a member of the Fed? Stay tuned.
Mike McKee, we will stay tuned. The news conference about 28 minutes away. You run into that. Mike McKee there.
So, good afternoon. 2:03 p.m. Eastern Standard Time on this Wednesday, January 28th, 2026. I'm XRP Future Millionaire, and I reside in the great state of Michigan. So thank you, everybody, for tuning in. Thank you for coming in here to watch this live press conference when it begins. We've got about 27 minutes. And they did not cut rates. We know with crypto, we were hopeful that from the crypto sides, purely from a risk asset, that they would not raise rates at least, but we were hopeful that they would raise it or lower them. Me personally, I want a 2,000 basis point rate hike, 20%. People always complain, but it'll get our savings rate up. Notice they cut rates last time 1/4 of a basis point, which is what led me to believe that we were in trouble, which is what I projected to happen, is that they would lower it, but the actual bonds and stuff would go up. So like we were getting a negative return, but the bonds went up. So we'll see. The markets very well could have priced this in, knowing that this was going to happen. And we'll see if we can make some kind of run of it. But I don't know if we can do anything before Powell speaks, because we have to see what kind of mindset he has. I think the markets are still more neutral right now because we're trying to see what he's going to say. Like, is he going to be hawkish or dovish? Is there anything about your expectations here, everybody? I would love to know everybody's expectations. Do you think we get a breakout here, start to break past? Do you think this is going to send us down? Do you think we're waiting for Jerome to speak? Because right now we still have this inverse setup, a double tap down here. We're still on the top side of this area. We've got a little golden cross forming. What we're waiting for is a push up over this resistance with a little bit of volume for confirmation. We're in what looks like a descending, broadening wedge, possibly, or broadening channel, maybe. But a lot of unknowns here. A lot of unknowns. The only thing we do know at this exact moment is that they kept rates the same. We don't know why. You know, we don't know what their philosophy is going to be as this goes forward. So this right now is literally, you're throwing a dart right now, and, you know, you got to go with your own understanding. Like, for me, I need to hear what he's going to say now. This is where I'd rather just have a chunk of cash sitting there and waiting for the inevitable. Either he says something that drops the market out, or he says something that sparks my interest, and I'm like, okay, this is going to get us going. Other than that, I think this is a lot of noise for leverage traders right now. His mindset is on his next job. Very well could be. Trump coming out with the tweet for sure. His fingers are on the fire right now. Something's going on. Yes, hit the likes, everybody. Thank you very much for anybody who's in here. We can listen to the news that's going on, so you don't have to hear me talking, because I always talk. We can listen to what they're saying.
There are a lot of moving parts in the chair, and so it'll be interesting to see who they finally select.
You and I remember the day where Phil.
So Fed votes 10-2 to hold rates the same. There was only two deviants, as they call them, or divergers from the pack. So only two people voted for a rate cut, and not or at least something different from it staying the same. That's pretty crazy.
Never say never, but as a policymaker and as a student of policymaking, the Fed tries to stay out of any and all discussions about exchange. I would expect Jay Powell today, if he's asked that question, to do the same.
So, Rich, when you think about yield curve dynamics, I mean, what is your view on what the yield curve will do? The consensus has the view that it will steepen. Is that also your view, or do you think front-end rates will stay stable and long rates will also stay stable, or how do you think about the curve at the moment?
Yeah. No, hi, Torsten. What's been remarkable is really since either going back to the last hike, which was all the way back in 23, or the first cut in 2024, the 10-year Treasury has been in a range from roughly 4 3/4 to 3 3/4. quarters. A lot's happened in that intervening period. That importantly reflects much higher real rates than we had pre-pandemic. So you have seen a shift up in the curve relative to pre-pandemic. And yes, would expect the curve to continue to steepen over time as 10 years stay in that range and as front-end rates come down under the new chair.
Rich, as you identify a range, impressively stable so far. For you and the team at PIMCO, Rich, what's the biggest pillar of that stability that we've seen over the past
This is going to get ugly.
the long end of the curve?
It's going to get ugly. If the 10-year moves up like it looks like it's going, this is going to get friggin' ugly.
Both because potentially a faster productivity growth and fiscal.
That is going to melt people's dicks right out of their hand.
Longer-dated real yields are higher than they were before.
If that plays out, Lord have mercy.
Fact of life. I mean, the real debate and the real issue is, within the Fed and in the markets is, where's the neutral rate? Where do front-end rates end up? And we still think that neutral for the funds rate is somewhere down around 3%. But obviously that's going to depend on where we are in the cycle as well.
And this may be an unfair question, Rich, but I mean, do you think an incoming Fed chair is going to make dramatic changes to the Fed staff in terms of who's head of which departments? Or how do you think the incoming chair might think about things if he or she doesn't think that it's likely that interest rates are going to be coming down because of persuading the committee?
I'm not sure about that. It is important just for the public to know that the board staff does report to the chair. During my time there, Chair Powell asked me to get very much involved with the staff, and I learned a lot from them. But I think there typically have been and always will be changes in staff. People get promoted, people moved on. And I should say during my time at the Fed, the senior staff I worked with was incredibly capable. So I don't think there'll be any issues there.
Torsten Slok, I think it's so important that we describe the academics of Richard Clarida, all that he did with his fancy thing, dynamic stochastic general equilibrium theory and monetary policy. John mentioned earlier, do we know the reaction functions? Do you have an operative theory from the world of Richard Clarida now that's operational?
Well, Rich is world famous for the credit multiplier and the work he did with Bernanke. And of course, what credit markets have been doing and what credit markets are doing is often very critical, of course, for the economy. Because if credit conditions begin to tighten, the economy has a problem. If credit conditions begin to loosen, of course, the economy could also have a problem, namely that it just becomes too easy money, including in credit markets.
And John, conversation after conversation, the assumption is credit markets are going to loosen because we have, maybe it's Biden-like stimulus. I believe the next 6 months, we're full bore ahead.
The credit spreads are very tight, and now the dollar's weakening. And when you think about the dollar's influence on financial conditions more broadly, Torsten, what is the contribution that comes through the FX channel?
Well, what I think is very important to remember is that foreigners come to the U.S. for two reasons. They come to cut coupons in fixed income because yield levels are higher here, and they come to get exposure to AI. So for any discussion for talks about, well, with the dollar beginning to go down, you need to come with a view that either AI is going to roll over or interest rates are going to be a lot lower. So as long as you can cut coupons and get much higher returns in U.S. assets, you will still have foreigners abroad in Europe, Japan, Canada, Australia, who come to the U.S. to buy U.S. financial assets because they simply do offer higher returns than what you get in most other countries.
Foreign holdings of treasuries at the end of last year, close to the end of last year, record highs. People hardly talk about that, do they?
Well, and if you go back and look at the tick data for net foreign purchases of U.S. assets, you saw that in April of last year during Liberation Day, things were absolutely chaotic. It was indeed the case that the rest of the world was sell America. But since April, for the data we now have from May up until November, it was very, very strong inflow of data into rates, in particular credit, and also, of course, into equities.
If you are just tuning in, welcome to the program. About 10 minutes ago, the Federal Reserve leading interest rates unchanged. 2 votes for a 25 basis point reduction from Governor Waller and from Governor Meyer in a news conference with Chairman Powell in about 20 minutes' time. We've got the former Fed Vice Chair, Richard Clarida, standing by just for one more question. Rich, I want to come to you on this, an important topic, because the Chairman will be asked about this in the news conference. I have no doubt of that. A more confrontational approach, a more assertive approach from the Chairman a few weekends ago towards the White House. Rich, what do you think prompted that? How much internal debate was there about it?
I'm not sure. I guess we'll have to wait for Jay Powell's memoir to to find out. I just infer that the chair made the decision.
I don't know about the rest of you, but I don't know if I necessarily like the look of that in the total crypto market cap at this exact
in
moment.
the past, and I think he just made a decision that he wanted it to be known that he felt that the Fed
I don't know if I
would
necessarily
focus
like
on
that in the total crypto market
independence
cap.
and
Thank you
focus
very
on
much.
making the judgments on monetary policy.
Do you
But
think that's
I think
made it
any
harder?
color beyond
Hopefully
that,
he's not. If
we'll have
he
to wait for the memoir.
Rich, do you
he
think
better
that's
come
made it
out and say
harder to
something in
focus
our
on monetary
favor
policy,
today.
I really don't. I don't think so. In light of all the things that are going on, I think it was a very clear indication that for the remainder of his term as chair, that will be the focus.
Richard Clarida, thank you, sir. As always, the
Thank
former
you.
Fed Vice Chair, Rich Clarida. We have no doubt the chairman will be asked about that issue in about 20 minutes' time. Joining us now to extend the conversation, Bob Michael of JP Morgan Asset Management. Bob, you've always got your own questions, buddy. What do you want to hear from the chairman in the next hour?
Well, the question he's not going to answer is, does he intend to stay on if after his chair expires? But I think the one to ask is, what does he see in the labor market that's particularly wearing to him? And
That's
is
basically
the
it
Fed
right there.
undergoing studies about what the broader impact of AI will be across the economy?
We're gonna come back. It's
Well,
gonna
Michael,
have to
the
test this
key
with what they did
question
with
that
the
you mentioned
rates.
is labor. We mentioned this earlier off Orzag and Posen recently. Does your team at JP Morgan see any form of wage dynamic that indicates inflation?
Not so much right now. I think this low hire, low fire has really dampened wage gains quite a bit.
Watch, we can
We'll
create a
see
little
what
range.
happens in
Watch,
the
this is
first
kind of
half of
nice because of the way it came
Certainly
up.
expectations are pretty good for the economy and corporate spending.
We can create a
Maybe
range.
that will lead to higher wages, but right now you're
Nice
not seeing
extending
evidence of that.
range.
I really
It's gonna look
can't emphasize
awkward,
enough,
but
folks, that phrase
it'll
I've
do us
seen
well
over
if this
the
pattern's gonna
of the
continue.
year. Then Bob Michael, with that,
Because it's gonna be tight.
strategy and getting
Oh, it's gonna
all
be
the
tight,
upside
old
at the
Bessie.
Fed, how far out is the Bob Michael vision at JP Morgan? Can you get out to Q3, or dare I say, model out a fixed income portfolio to 2027?
You can and you have to. You can't invest a lot of
Wow,
assets
it's gonna be
without having
super
some
tight in
view
here.
on the short term, the medium term, and the
Like
longer term.
super
Right
tight.
now, things look pretty good.
This has to. We need a
On
little bit of
Monday,
news right
I
about
said
now.
that the yield curve looked about as
This was
perfectly
basically,
placed
we need some
as you
news
could
to
have
keep
it.
this from
So
coming
does the
back
bond
under.
market. It seems to incorporate
Otherwise,
reasonably good economic activity this year. It seems
well,
to incorporate what we think could be disinflationary forces.
we could fall into the
coming
liquidity
from both
shitstorm
Fed
here, so to
news,
say, in the
tariffs
famous words
on
of Jim
spending, and
Leahy.
also the impact of AI.
The
It's
shitstorm's
an
brewing
ideal
out here.
market for bonds, including credit.
And there's no way I can draw this where I'm like, oh, I love this. Although I do like the fact there's a W.
A bigger weight in the public IG index. And by the way, AI is
Does that help?
in venture capital too.
I'm just trying to see how we can get out of here.
How do you think about the construction of portfolios at the moment when you suddenly have, when you look holistically at asset allocation?
Yes,
one
the shit
factor being
wins.
AI
We have a
that
fan.
is
We have a
everywhere.
fan.
Well, we've seen a lot of sectors in the past access the markets for a lot of funding. And the lesson from that is to wait until the supply starts to weigh on prices, and that's your opportunity to go in. I think what we do under.
Oh, I understand. You're not trying to cause panic. You can only listen to these schmucks for so long anyhow. But no, you're not causing panic. Would it be smart? It wouldn't be unwise to have a few orders down there if you're looking to buy. It just depends if that's your area of, okay, this is where I think it's not going to go any farther. I'm going to get rid of these idiots for a minute. If it comes down there, we might have to face some other demons if we do come into that range. But yeah, that $1.58 to me, it's a strong area. It's like $1.56, I believe. Something close to there. But it's different on different charts. This one just beautifully led us into a positioning like this where it makes a lot of sense. And the fact that every single time we come back up to this resistance line now, it just comes through. It almost makes it feel like it moved it into some kind of symmetrical triangle. Maybe it's like trying to heed the kick in the you know what. And rate cuts rate staying the same do not help. You know, with everything else we were dealing with, you really don't want to deal with rate staying the same in a risk asset. Even for gold and silver, for metals, it could make it interesting because they're thriving on the fact that they keep cutting rates, but staying the same is not. I don't think that's what's going to necessarily kill them. I think this would be a bigger indictment on risk assets again. Staying the same means nothing because they didn't raise rates, which means they're still harming the economy. So it's not as big of a hindrance on metals as if they would have raised rates. If they would have raised rates, now we have a different story. Well, with crypto, if they would have raised rates, we would have a really different story. But it could end up being a blow off the top here for the metals for a little bit. We don't know. Just enjoy it while it's going. For crypto, on the other hand, a blow off the top would feel great right about now, even if it is a 10% blow off the top. Crypto has just been the perpetual loop of sorrow. Let's see. Yeah, on the daily and weekly, that's where our hope is. Our hope is that we're consolidating out of this short-term area and that this is going to hold. That's why I said this would be the time to hold now, right about now. Because with what we've created over the top, just right about now would be a good time for XRP to bust out. Because you see how this is tightening? This is actually the extended range. Let me put it in white on the resistance. No. Yeah, that'll work actually. Let me go to 3. Let's get rid of this. And then that over the top, that's this pattern tight. It's at the apex. We're at the apex of this setup. So if it's going to break out, the apex would be at what time? 2300. So we've got about what, 12, 13 hours left. Is that what's going on here, I think? Yeah. We've got about 12, 13 hours to figure this out. Anytime before then, it can either break out or break down. Right now, it's over the top. Whoops. You can take this however you want it. You can read into this however you want. We still have a defined inverse head and shoulders. Staying the same for crypto, too, is not the end of the world. Because nothing changed. Now, it could bring a lot of liquidity, but sometimes to get to that lower liquidity we talk about, you got to get that upper liquidity first. So I just want to see what Jerome says. Because we have to hear if he's Mr. Hawkish or Mr. Dovish. If he comes out and he's got the tone of, we're going to raise rates in 2 months, we're going to start cutting back on the printing presses, we're not going after, and if he starts talking like that, well, oh shit, you better get the umbrella out because it's going to start pouring. But if he comes out and he's like, well, and he does his nonsensical bullshit like he always is, hey, we got to look further into the data. We didn't want to go out on a limb too far, especially not knowing the data in the future. And we would have, maybe we would have lowered rates, but the data just doesn't support it yet. But once we get that data next month, then we'll be able to decide for the future. We even teetered in maybe raising rates this time. If he starts saying that, that's where you get on the little bit more of the uh-oh side. If he starts going towards, I know we didn't cut rates, but the interesting part is we highly considered raising rates at this meeting a fair amount of time. If they start talking about that, that's when you start to go, ooh, well, this has been a fun show, ladies and gentlemen, but we're going to have to get our, smiles out because it's going to be quite a ride if he starts talking like that. Absolutely. That's been my key point. That's why I want to see that move to $1.97 because over $1.95 we're in the golden zone. If we get over $2, we're pretty good to have a push up at least. At least it's about a 10 to 30. It can even extend out to like a 30-something% rally. I am scared money right now. Scared money. I think that's appropriate right now. Anybody who says they're not scared a little bit, what I'm looking at right now is a key, XDC. I'm not really watching many other things. I think the coup de grace is going to be made in XDC at some point here as well. But it's telling us, we lined this up earlier that it was in this little bit of a descending consolidation. The question is can it honor this 383? So far it has. And right now it's elevated. So, We have a lot of guessing to do here because we don't really know. But, you know, the 3-hourly is pushing down, which is never really a great sign. The 4-hourly is pushing down. But again, a little bit of volume can rotate this a little bit. When we talk about no man's land, if there was ever a no man's land and a sorry feeling land, would be buying at this exact point, not knowing what the hell is really going to happen. I mean, you could buy at this exact time, but you'd have to have a game plan at this exact moment. There's so many different variables right now. The thing that sucks is there's another variable. When Jerome Powell starts speaking, I'm going to have to leave, and this is going to be playing without me here until I get back with my son, and I usually get back around 3:15, so I'm going to be gone from like 2:40, so for 35 minutes, and he's usually still on when I get back. I'll be watching it on my phone. He's last time he was on, but I want to keep playing this so the audience can talk to each other and things like that and hear it in real time. So I'll be able to hear about the first 10 minutes or so, and then I'll have to watch it, and then I'll be back. But I think it's a good thing to do with the audience. So if you're in here, make sure to hit that like button. About 40, not even 50% hit the like button. That's okay. Just hit that like button. See, the algorithm works in a fashion. You hit that like button, YouTube's like, hey, we can push this out to other people because people are interested. When you see the video be posted to the algorithm, you know, posted to not just in these comments, because I get a lot of comments during the live, but when the live's actually posted or my other content is, there's not a lot of comments, so the algorithm kind of is like, but people still see the content in more ways than I'm grateful for. I'm just generally curious about what's going to happen here. We got the escrow dump coming on the 1st, so this is always a volatile area for XRP. It's just in that crazy spot. This is where, though, if it can push out of here, it's either we go right up, or when he's talking, we come to $1.85, and then we push out. It's almost better for us to come to $1.85 to grab that liquidity, so we wouldn't get steamrolled at $1.94, which is only a couple cents up. Grab that liquidity, come up, push out. But we really... Just Tom, this is great. I appreciate that. I like this too. So we got 5 minutes. Let's go to the right channel here. Bloomberg.
Do understand is
oh no, we don't want Bloomberg.
Need of
are left wanting. I think it's very important to understand.
Well, we know they're lying on Bloomberg. No reason to even watch it. We got to put this on because this is when he's actually going to come out. So, okay, so we'll go back to that after. If you want to watch that on your own too, it's at the Federal Reserve website or the Federal Reserve YouTube channel. That's their official YouTube. Or you can just watch it on their website. I believe it's the Federal Reserve or FOMC. Otherwise, you got to go through the fake ones. There's somebody doing the fake drum pull. It's got so many people watching it because what they do now, I've noticed, is they make what they do is they make the web page, and what they have in the name now, it makes it look like it's a news station. There was one going there was like 6,000 people watching when I came on here. It said he was live and he was talking, but it was AI. Oh, it's not on here. I wonder if they closed it down. You hear that? That was all the brown nosers in the room. Ah, small joke. We'll wait for this to come on at 2:30. We don't need to listen to the news stations and propaganda. We get enough of it from Jerome. A little bit of... Ooh. What's this? Let's go to a different chart. What's this, Foreman? What's this tomfoolery? Anybody else see the tomfoolery trying to form? It's gonna be interesting if I have to come from the other direction. That would make it a little interesting. There you go. There's your little range that's forming. Now, we could do this a little bit different, and I don't know how many people would want to do that. Like, hey, Tom. I like people that do this. Because I like this a lot. When you start going into a different kind of thinking. And I'm like, ooh, what if you progress it to this then, if you were thinking like that? And then it's like, oh, hey, Lord have mercy. That's what we're looking at. First time up, couldn't get through, consolidating within. We'll see what happens in no man's land. MQ, oh yeah. This is where the big bucks are made or lost, my friend. This is where the insides will come pouring out in 2 seconds. What's gold and silver doing? Let's see if it gives us a clue. Platinum's still hanging on up 3%. I'll give it credit. Even PLG's hanging on like a champ right now at 340, I must say. Same with B2 Gold. Miners don't know what to do. They're still hanging on, though. Not too bad. Less than 2% across the board. B2 Gold is up almost 2%, which is nice to see. It's my largest holding. Let's see. Silver is at 113, so it hasn't really moved. I think we're waiting to hear what old Uncle Jerome says. Old Uncle Jerome, and it's crazy because gold's hovering right at that level that was the projected target out of that consolidation. So now we're above here now. So are we going to consolidate on this area now, and then we can just keep going and not come down below this? That's where it would get interesting. It's incredible though. We've been going pretty vertical when it comes to some of these metals lately, and it's been a awe-inspiring journey. Let's see. Eventually that's gonna come on. He's gonna be out in like a minute. The sphincters are starting to tighten in the market, as we see. Very tight indeed. It's like XRP's like green up. It's like the plague whenever it sees green and has to go right back to red where it's safe. Have you noticed? A little bit of green. Oh, that hurts. Oh, nope. Let's get back to red where it's safe. Ah, here we go. Here it comes. What happened to the volume? Oh, there we go. All right, I'll shut up.
My colleagues and I remain focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026.
Good to see he's going to be a liar right off the bat.
While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. A temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months, Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%.
Like, I'm sorry, but the US dollar is down 2.8% since the 19th. I would love to hear about that. Sorry.
Since last September, we have lowered our policy rate 75 basis points, or 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%.
Oh, this is brutal.
Once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored.
We'll have to see, MQ.
Delivering on these goals
Not yet.
matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
Hell, he might not even be on when I get back. That was quick as hell. 5 minutes? That's all he had to say, 5 freaking minutes?
At Associated Press, thank you.
Brutal.
I wanted to ask that, you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with, I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important.
MQ, I'm looking at PLG if it did have a dump down here. I'm looking at it very deeply.
As I thought about it, I thought it might be hard to explain why I didn't attend. In addition,
or if it holds.
Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement Let me pull it out.
God, this is getting worse by the minute.
Simply, it used to say that judges that downside risks to employment.
Yep, Meta, 100%.
So we saw, data coming in, which suggests some signs of stabilization.
All right, so do you want it to be focused on the US dollar when I leave and like this? Or do you want me to focus it on gold or silver? Let me know. DXY, gold or silver. And then we have the charts right here so you can see most of these all the way up to Ethereum.
I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting. And that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So
today, all right, guys, I have to go get my son from school. I will be back.
I'm simply going to refer you to the statement that I made on January 11th. I'm not going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today, and some ancillary areas, but I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Mike.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today. That either.
Why would you want to leave it all under the circumstances?
Again, I don't want to get into this. It's not something I'm. There's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the US currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency, and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
But what's your view on the market movements? What do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the beige book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made, what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve Leisman, CNBC, and sticking with questions you might answer, thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the S&P and the longer run rate, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. And maybe I missed by 1, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy's significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course no one knows with any precision. Is that, you got to follow up?
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the S&P from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, 3 the Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Amira. Thank you, Chair Powell. Mara Moakley from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks have probably both diminished a bit. So, we'll be looking at that. It's about how you weigh the risks to the 2 goals and how big those, and quantify them. And so there are different views on the committee, and, we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and you know that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, you'd get, and you would, I mean, inflation, core PCE inflation is running just a bit above 2%, x the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, if we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the Band-Aid as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy's in a good place. I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, you a minute ago you said you felt expectations were consistent with your mandate, that the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
Andrew.
Apologies if this is a little bit repetitive, but in the past you said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
We haven't made. You're right. We saw the labor market weakening, and we acted, and I think that was the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments, too, on inflation, though.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now, anybody's base case, that the next move will be a rate hike. But, ultimately we'll do what we think is the right thing. But that's not where people's expectations are right now.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
Over time, you've seen that U.S. rates have remained they haven't moved a lot really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But right now we're running a very large deficit at essentially full employment, and so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with, and that in the end game, that's where you wind up, is in some kind of a difficult thing. But that's not where we are. It's not where Japan is either, but it's certainly not where we are right now.
Does it reduce the effect of your rate cuts that longer term rates have overall not really budged that much?
I wouldn't say that. The thing is, technically, higher longer term rates means less accommodative financial conditions. But remember, many things move longer term rates. It's not mostly what happens on the short end. There can be effects of longer term rates from moving our policy around, but it's much more assessments of the fiscal path and fiscal policies and risks and things like that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between 10-year rates and the overnight rate.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Republican Senator Tom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile. So I'm not talking about the U.S. context. This is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, it's first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions, you know, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Archie.
Archie Hall from The Economist. On that sort of stabilization of the labour market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labour market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. You know, supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, you know, it shows, it's a survey showing that workers feel like job availability it's a very low reading. It's just one reading, but it's an indication of softening. People, part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, I could go on and on, there are lots of little places that suggest that the labor market has softened. But you're right, part of payroll job softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. You know, so imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in balance, you know, that you could say that's full employment. At the same time, do we really feel like that's a maximum employment economy? You know, it's very challenging and quite unusual situation.
Thanks. And one more on growth and the kind of strong growth outlook, or strengthening growth outlook you're now seeing. How much of that is the fiscal stimulus we're seeing from the beautiful bill, the tax cuts, and all of that? So
you're seeing it already. You don't have much of the fiscal. I think the outlook, you're right. It's financial conditions, and it's fiscal policy for 26. But you've got strong consumption that's been happening before financial conditions have been supportive, but before the fiscal effects really are shown. So essentially, the economy has once again surprised us with its strength, not for the first time. And, you know, consumer spending, although it's uneven across income categories, but consumer spending overall numbers are good, and we're benefiting from the AI build out of data centers. That's another thing we're benefiting from. But the economy overall, the growth is on a solid footing. It looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven. The president calls inflation defeated and solved. The FOMC says it's a somewhat elevated inflation. But you talked about those customer survey or those consumer sentiment surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues about how wealthier consumers seem to be driving so much of the economy, and why so many families still feel like they just can't make ends meet after 5 years of rising prices. What is that discussion like?
So a couple things. One, there's something to it in that we know that higher income households that tend to own real estate and tend to own stocks, securities, and those assets have been going up in value, and increases in wealth do support spending over time. So, and that's clearly a part of the story. We also know that for some time now, for a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands, and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and that is a reality of what we're seeing. They're still consuming, but they're feeling it in a different way. I would say more broadly on affordability, we have a vast network through the reserve banks and also through the Board of Governors, where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart, because one of our jobs is price stability, and so the best thing we can do for people who are feeling that squeeze is to keep inflation under control, and frankly, to finish the job of getting inflation back down to 2%.
You mentioned the AI build out as being positive for economic growth this year. I wonder, as you look at the weakest year last year for job creation of a non-recession year since like 2003, are you concerned about AI maybe supplanting more entry-level work and entry-level jobs, and how does that play into what you're watching about the labor market?
So everyone, of course, is watching AI and the deployment and, trying to understand exactly what's happening. And there's a wide range of possibilities. It's hard to say. And of course, anyone who uses it is amazed at what it can accomplish, right? So every technological wave will eliminate some jobs and create other jobs. And it's always been the case. If you look back, wave after wave after wave, there will be some disruption, but ultimately technology increases productivity, which is the basis for rising wages. And it may not all happen immediately, but over time, it's what enables incomes to rise over time, is rising productivity. So and we always ask, well, this is going to be different, is it going to be different? And we don't know. And we may, in any case, see in the short term jobs that are being eliminated by the capabilities of AI. We may see that. We just don't know what the overall effect is going to be. So how to think about it in macroeconomic terms, it's very hard. We can look at the aggregate data. We can analyze, for example, there is some connection, it appears, between the low hiring rate for recent college grads and AI, but it's not the main or only driver. You hear large companies, though, many of them saying that they either won't be hiring for some time, or that they're hiring less, or that they're laying people off, and they tend to refer to AI when they do that. So we're all watching and learning, and it could certainly have pretty significant effects on the economy, the workforce, and our society. We don't really have the tools to address the concerns that may arise, but we have a lot of people who focus on analyzing it and try to understand what the macroeconomic implications are, which is our job.
Thank you.
Thank you, Chair Powell. Bayi from AFP News Agency. You mentioned earlier that on inflation, the broad expectation was for a one-time price increase and then for inflation to come down. And I was wondering, is your expectation still for inflation to start cooling in the second half of 2026? And if you could elaborate how far we are from target currently. Thank you.
So how far we are from target is, as I mentioned in my opening remarks, we had 3.0% core PCE inflation over the 12 months ending in December, and that's pretty much what we had the year before. So on net, no progress, but the story behind that is modestly positive in that most of the overshoot was in goods prices, which we think is related to tariffs, and ultimately we think those will not result in inflation as opposed to a one-time price increase. Okay, so that's where it is. In terms of, you asked, no one thinks they will, ex ante understand really clearly precisely when this will happen, but there's an expectation that sometime in the middle quarters of the year we'll see tariff inflation topping out. So what we do is when a tariff is put in place, we track the effect of those tariffs over a 6, 7, 8, 9 month period, and you can see for that tariff how long it takes to reach a place where it's affected the price level, and that's it. So we're getting better at that, and our estimate is that it'll be sometime in the middle of the year, but I wouldn't look for great precision in that. But we'll be able to see whether things are moving in that direction. I think we'll be able to see.
Richard Escobedo.
Thanks, Chair Powell. I'm Richard Escobedo with CBS News. I want to look outside the U.S. about what's happening outside our shores and how it impacts the U.S. Canada's Prime Minister said last week that there's been a rupture in the global order, and I wonder how you're thinking about geopolitical risk as it relates to the U.S. economy.
So I can't comment on that speech or statement or anything like that. Geopolitical risk for us is a lot of it is around energy, oil. And so far, we haven't, for all the turmoil, oil prices have come down, as you know, and so we don't really see much. Longer than that, it's trade, and the trade, our economy has pulled through pretty well, you'd have to say, given the very significant changes in trade policy. The U.S. economy has pushed right through. Partly that is that the way that what was implemented was significantly less than what was announced at the beginning. In addition, other countries didn't retaliate, and in addition, a good part of it hasn't been passed through to consumers yet. It's being taken by companies that stand between the consumer and the exporter. So that's where that is.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With third quarter GDP growing at 4.4% and the fourth quarter expected to have a 5 handle on it as to what the Atlanta Fed is predicting, at a time when you had a government shutdown and we thought that was going to shave off some growth, you've also got the fiscal tailwinds you've talked about, big tax refunds coming, potential tariff dividend. How could you cut rates and not spur inflation in that environment?
Well, we didn't cut rates today, but it depends on how fast potential output is growing, right? I'm just asking in principle. I'm not saying this is what's happening, but there's growth and there's how fast the potential is growing, and at a time of high productivity growth, potential output is rising. So it really matters whether potential output is growing as fast as actual output, and it would matter over time. The numbers you cite were for quarters, and quarterly GDP is, you need to look at 12 months because quarterly GDP can be very lumpy. GDP was negative in the first quarter last year. So the overall, over the year, the numbers were nothing like that. It was more in the mid-2s for the year.
And how do you explain the divide right now between strong economic growth and the job market? Is it productivity that's filling the gap? And is productivity being driven by AI at this point?
So you're right, there has been a divide of solid growth, but what looked like a weakening labor market. And that can be explained by rising productivity. But I would say we do see signs of certainly of the unemployment rate stabilizing. So it may be we're seeing the beginning of the resolution of those two things. Also, as you probably know, the lore is that when GDP and the labor market get into an argument, in the end, labor market data is more reliable. GDP data is just very hard to collect and understand, but nonetheless, I think we may be seeing that tension resolving a little bit. Too soon to say with any confidence, though.
Matt Egan with CNN. Chair Powell, after today, you have 2 meetings left as Fed chair. You've obviously experienced a lot during your time as Fed chair, served under multiple presidents. I'm wondering what advice you have for whoever your successor might be.
Honestly, I'd say a couple of things. One is stay out of elected politics. Don't get pulled into elected politics. Don't do it. And that's another thing. Another is that, our window into democratic accountability is Congress. And it's not a passive burden for us to go to Congress and talk to people. It's an affirmative, regular obligation. If you want democratic legitimacy, you earn it by your interactions with our elected overseers. And so it's something you need to work hard at, and I have worked hard at it. So, and the last thing is, it's easy to criticize government institutions so many ways. I will tell whoever it is, you're about to meet the most qualified group of people you not only have ever worked with, you will ever work with. And when you meet Fed staff, and not everybody's perfect, but there isn't a better cadre of professionals more dedicated to the public well-being than work at the Fed.
Thanks for that answer. If I may follow up, as I'm sure you've noticed, gold and silver prices have experienced historic gains of late. And I'm wondering how much attention, if any, you pay to those moves and what message you may take from these significant price increases we've seen for precious metals.
Don't take much message macroeconomically. The argument can be made that we're losing credibility or something. It's simply not the case. If you look at where inflation expectations are, our credibility is right where it needs to be. So we look at those things. We don't get spun up over particular asset price changes, although we do monitor them, of course.
Nicole, for the last question.
Hi, Nicole Goodkind-Barron's. Some prominent critics have charged that the Fed's economic models are somewhat backward-looking, but should be more forward-looking, incorporating things like productivity increases from AI. How do you incorporate current and future developments into your analysis and decision-making, and do you have an answer to those critics?
Yeah, so by and large, those criticisms, as somebody on the inside, they just don't make sense, and I'll tell you why. Every FOMC participant writes down a forecast every quarter, right? The summary of economic projections, and that's the basis for how we think about the economy. So, and the other thing is, what an economic model can do is it can grind up all the data for the last number of years, 50 years, let's say, and it can identify what are the relationships between variables A, B, C, D, and all that kind of thing. And it can tell you if you change one of those variables, this is what should happen in the macroeconomy. That's just the way it works. However, the structure of the macroeconomy is constantly changing. For example, we hadn't had a pandemic in 100 years. It wasn't in the model, and we knew it from the very beginning. It was not in the model. A trade war of this scope, we'd never had that in 100 years. And so there's great uncertainty at different points. Another thing I'll say is, when it comes to, technological developments that raise potential output, some kind of technological revolution, like happened in the 90s here and like maybe happening now with AI, we're all over that. And, everyone studies those periods, and, we're very clear-eyed about the possibility that this higher productivity may persist, and also that it may not. We're not, no one's sitting here unaware of the possibility of higher productivity. We've been talking about it for 3 years. It long predates the current situation. It's been going on for 5 or 6 years. We've had productivity higher. We've been talking about it that whole time. So it's very much on our minds, and we are well aware that higher productivity means higher potential output, and it changes the way you think about potentially inflation, growth, labor market, and all those things. That's all in our models. I mean, if it's just a question of using better models, bring them on. Where are they? We'll take them. But I think, we certainly are in contact with anybody who does economic modeling, and we're always looking to do better at that. But that's how I think about that.
And just a quick follow-up. We've been talking a lot about tariffs and passing through, and we've been talking a lot about them for the past few months. The trade landscape is still in a constant state of flux. Announcements, threats, negotiations, they're all frequently changing. So I'm wondering how you actually track these, what data or channels are most critical to follow this in real time.
Trade?
Yeah, the impact of tariffs and how they're changing.
Yeah, I think our staff has done a really nice job on that, and they've kind of put it together in real time. So as I mentioned, a tariff gets put in place, you can pretty much track its effects on pricing and on everything. And so you build a model up from all of the tariffs. At the beginning, it was very much of a forecast. Now it's every cycle that goes by, it becomes more informed by actual data. And our forecasts were not far off. What changed was, as I think I said earlier, what was implemented was smaller than what was announced. In addition, we didn't see retaliation internationally, and I think people did generally expect that because we saw that in the past, and that really mattered too. And then the other thing is that pass-through didn't know how fast that was going to be to consumers, didn't know how much exporters would take, how much companies in the middle would take, and how much the consumer would take. And it turns out it's a lot of companies in the middle who, by the way, are pretty strongly committed to passing the rest of it through, which is one of the reasons why we need to keep our eye on inflation and not declare victory prematurely.
Thank you.
We're done?
We're done.
Okay. Thank you very much.
Okay, for anybody who's still here after, I know it ended soon. I figured it was going to end sooner today. I got that feeling before I left. I don't know how many people are still here. Crypto basically unfazed, hasn't really done much. Let's see, gold 53.36. So that's had the best part of this. Silver come up a little bit. B2 gold seems to be faring the best. That's an interesting area. PLG is an interesting spot to watch as well. Because if this holds, it seems be in a pretty nice consolidation still here. And platinum still, if the progression is going to continue up with the trend, and I don't even know if I'm just talking to myself or if there's anybody here, to be honest. 57 people stayed. Awesome. Oh, just finished at 320. Oh, excellent. They were talking about gold prices. I really missed your FaceTime. You need to put a picture of your face up when you leave. I know I should have put my technical analysis picture up there. It was I had to rush out of here pretty quickly, unfortunately, because I had to pick my son up from school. So I do appreciate everybody who stayed in. Jay from MX, thank you so much for not only being in Town Zone for your first month with the emoji badge and me being abducted by aliens, but also gifting a sub. How awesome is that? That's awesome. Get down, man, again. Normally I put this on, so at least, you can see. Why does it look like that? That's not even my current background. Interesting. It really uses that on the lives now? Well, that's pretty interesting. I didn't know that. It didn't update it on the... Anyhow. So, yeah, what do you guys think? Do you think the platinum side's an interesting play right now with PLG? I'm just curious. I want to know the angles. With crypto, price hasn't moved at all. It's still right at the $1.92 part when I left. This, I think, is exactly where it was at. Like, I think almost to the T. XDC's down a little bit further, which is kind of not unfortunate to see because it looked like that's where it was going earlier. So now we have to see at about 382. That's pretty predictable, which means maybe the rest of the market will stay pretty predictable. I am interested in PLG though, with the way that things moved, the fact they stayed the same. If we're gonna get upward momentum here with what gold looks like, it seems like platinum would be another sneaky play that could come up here if this was a true double bottom. Because look, we had a nice inverse shoulder head, and the way this flexed out into a shoulder, the fact it's elevated is actually a good thing if this breaks up. And conventional theory or wisdom or logic would say in the daily time frame after a nice back test, we got to see because it's 322. It's still kind of a little bit of a bearish close if it were to end here. So it's for platinum, it's interesting. It's interesting for all of these because where we closed, what happened in the meeting right now, it does leave a little bit of interest to me, especially with how PLG looks. That looks like an inverse pattern possibly set up here. Almost the makings of a hammer candle to end the day. Like, I don't know. I could certainly see taking a shot somewhere in... Yeah, PLG definitely made some bank this month. Now the question is, after a bit of a reshuffle, do I dig back in as heavy as I just was? I mean, it dumped out pretty good. It's a pretty nice savings. And the consolidation is it's at that part of the move now where it's tricky. Is this going to be a continuation, or is this where this trade starts debasing? Well, based on what gold is doing in particular, more so than silver. I don't correlate platinum with silver. I correlate it more with gold. With the movements, not exactly the same, but to an extent, that's the way that I like to look at that part of the market. PLG, I mean, let's just call it for what it is. This is very, very possibly early in this setup. Early. Not as early as when we were talking about it right around Christmas time, me and MQT. But it's still very early in the sense that if this is meaning to go, that's a nice flag up. Consolidation seems like it's on point with the basic consolidation. I don't see anything that's, crazy. I don't see anything real crazy here, to be honest with you. It doesn't seem so bad. So, we'll see if it can hold this. If it breaks down out of this, obviously it's going to come consolidate. But if it pushes out of this, I mean, it's got a big move still in store for it. And it's just breaking out of an inverse pattern. Yes, it's come up to that double top area and now the back test, and it needs to be over like that 335 area roughly, which it is. So it's very intriguing. This is a very intriguing circumstance where we're at right now. I mean, B2 Gold's doing everything I was hoping it would do through this push here. And now maybe it can get an expansive push. You know, maybe B2 Gold can get this expansive push. Now, I was hopeful that it could get a push through if gold played through because we were close. But we haven't got that move just yet. We're looking for a break above $6, really, on this push up. My target was $5.97. It came really close to it. It didn't quite hit it. I think it was within $2. Yeah, it was so close. It was within 4 cents. So, we'll see. We'll see. Rates staying the same certainly didn't hurt gold and silver. Now, it would have been better for gold and silver if it would have been rates cut. Because then it would have been like, oh, they're just continuing. But they didn't help themselves in the meeting today. It didn't help the case. So we'll see what happens with gold, silver, platinum. Gold's up $162 an ounce today. Unreal. Silver looks like it's breaking out into all-time highs if it can push through here. There could be a small argument that maybe you're starting some kind of rising pattern from a wedge standpoint, but I'm not even going to go down that road yet. We have too much momentum. As long as we get over this, I don't even need to argue that point. You know, that something's starting to tighten up here. So, this is what you're looking for. You break out of this, we're going to be off for a little bit. We're going to be up for a little bit. So, that's what we're looking at. Pay attention to PLG as the market's closing today. You have to make a decision there. If you think it's going to continue to trend up. Remember, it closed down. It didn't close, but it had dumped down to $3.02. It went down to $3.02 yesterday. Today it went back up to like $3.65, $3.70 in pre-market. And now it's we're just pretty much filling out this pattern. But I would look at it more like this if I'm being honest with the audience. I would look at it more like this because you don't want to get caught up in that down wick. Forget that wick exemption. This is the consolidation, and it's already proven us 2 areas. So now all we're looking for PLG is a move above 355 and push out, or a break below 330. I almost, It's very interesting. I got some haymakers to throw if I want to. I got about 33 minutes to decide this, so I'm gonna think about this long and hard. I don't hate what I see, though. I don't hate what I see. It's like you're sitting here and you're going, I don't hate what I see, but can I convince myself of what I see? Platinum, if this does pull up here, and it is oversold like a Sfiscati in the hourly, the 2 hourly's got tons of momentum that it could gather after clearing out a little bit. It's going to come down to the 4 hourly. The 4 hourly is beautifully positioned, too. Whew. I mean, this could be a sneaky, sneaky, sneaky one again. I mean, I'm just saying. What do you guys think? Oh, there's only 55 people. I forgot. Mrs. Stott, what do you think? Oh, that would be a great cannabis podcast. I would do the ball. I just caught that. Here's my sign for not catching it sooner. Oh, that is so funny. I don't know, Mrs. Stott. I don't know. I think I might have given another opportunity for a cheaper investment here because let's see where we're at in the daily. I mean, there's still a lot of room there. Weekly is where it's kind of kicked in the grotesques and the monthly, but that's to be expected. That's platinum, but let's look at here. Now that we see the platinum chart, let's see what it looks like here. 4 hourly. Point of contention. No doubt about it. We're at that point of contention zone. Whew, this is going to be a rough one at the end of the day. Because that could be setting up for something. Oof. I keep hearing about Canton. Yeah, a little bit. I'm just not as versed as I need to be. I want to wait for the Friday sell-off to see where it lays. I agree with that 100%. That's why I'm watching this this consolidation to see going into Friday tomorrow this will play out, and I think the apex of this is actually Friday, believe it or not, MQ, for this little small setup. By the way, can I say, I cannot say how much I appreciate you enough in the Telegram with all of your information. I cannot thank you enough. I couldn't even show my proper diligence to you how much I appreciate what you do. Yeah, the shutdown is definitely something big. It's definitely something big. Wow, we've been on for an hour and 30-something minutes. Ooh. I'm surprised 50 of you stayed pat. Honestly, that means a lot to me. Crypto's moving up a little bit here, 192.80. Because we didn't get any bad news today. Like what we got today, I don't think it would change the objective of what we were looking at if we're going to get that small bounce. MQ, what do you think? The way that it bounced today, that didn't hurt our cause for the movement here. It just, we need a little bit of volume. But we are on the top side breaking out now. Now we just have to push past the short-term barrier at $1.94. Oh, no problem, MQ. Definitely well-deserved, and those are even understating the facts. Gold is ripping it. Gold is absolutely ripping it. Gold is at 5,306. I can't even believe I'm saying 5,360 up 3.48%. And Bonafide going ballistic. Weekly, which is good with gold for a couple days at least. That weekly has still got a lot of desiring firepower possibly here. And that gold-silver ratio, it looks like it wants to go back up a little bit, but that might not be by virtue. That might be because gold's outpacing again, which is pretty, this is remarkable what's happening here. It's remarkable. And yeah, if you're on the sidelines and don't have gold or silver, the precious metal, I understand that it's a little, maybe a little disheartening to see this moving up like this if you're sitting in just crypto, but don't be disheartened, learn. Because rotational flips happen. Just pay attention. We just pay attention here. Everything has held pretty firm here. You know, through this little consolidation where every single one of them are trying to peek over. See, we're trying to peek. That looks kind of familiar, right, with algo. So you got that set up with algo. One of the ones we were looking at that has a pretty similar setup is right here with PLG, except that we can't go from the wick. But if you go from the lower base, it's pretty similar. You come up in the up direction, consolidate, almost like a cool-off phase. You go to algo. You got the consolidation, almost a cool-off phase in here. And now this is where you're bullishly optimistic, right? Like we've been saying, we're optimistically bullish. Cautiously bullish is a better word. But this is, theoretically, we could be breaking out to the 200-day right now. I see a move to 13 cents if this plays out minimum. Because it's going to come up, in my opinion, it's going to come retest this area. And that kind of a move, if it comes up there. Nobody needs to ask my strategy. It's triple X Haas strategy. If you're in here, that's all you need to know. XRP, XLM, XCC, HBAR, algo. Just can't seem to stay on top of it. No, it can't. It really can't. Right now, we're trying again. But it's like every time we get over, it's like I was saying, every time we see green, we get scared and we run back to the safety of the red. Just do the opposite of what Facebook says and you'll never lose money. I mean, that's not untrue. Claver said silver and gold are going to crash, so inverse Claver says don't sell yet. Oh, if he said it's going to crash, we're going to do just fine in the weeks to come. So I feel like I'm in just an awkward position because literally when I see gold and silver moving like this, because of what I put in there, it's like, how are you supposed to like kind of rationalize this? $180. That's the equivalent, or $170 will go on. You know, that's the equivalent of like a 20-something $100 move just in gold. And then silver, you add on, you know, $3, and that's another couple to almost $2,500, over $2,500. I mean, you're talking about, you're not even looking at anything else. You're making $6,000 today, $7,000. Like, you want to talk about a true transfer of wealth? And that's not even measurable because it's in a precious metal. Like, I don't look at that on a screen every day. That's just there for the next generation, and it's just growing. How much work I would have to do for this to happen? Do you know how much work we have to do? That's why they call it the transfer of wealth that nobody's even paying attention to. By the time retail even got wise of it, you're talking, we're approaching $100 plus per ounce of silver. Now that gold's at 5,000, people are starting to pay attention. People are starting to pay attention. Remember the untouchable on this entire list where I'm like, I think it's the one that really still is underperforming the market, is that B2 gold. So I have so much more of it than anything else right now. It's in a spot. I am very interested though in PLG to see how this plays, this consolidation. My gut's telling me that it's given an opportunity right now. I understand that it's a very tricky market though, so it could very easily backfire if you make a buy here going into tomorrow. What you'd be playing on is that this would continue in the platinum futures, and you would continue to have this upswing to the potential that we're playing back up and out, especially where we're at in the stochastic. I mean, the stochastics look phenomenal. Like, this looks pretty. I'm just saying, I know we're looking for the Friday liquidity, but as far as the platinum chart looks, and it can turn around very quickly, that firm bottom, and then this setup here in a shoulder with that falling channel looks like a flag. I mean, if this pulls back up and gets out of this range, I mean, we're very easily talking about a push up to here for platinum minimum, somewhere around 2,800 plus. And that's a bottom, boom. That's a good point, Carl, and I always have to remember that. I got to remember what it was like to be part of the herd, kind of. Trying to survive, but not knowing how. And even if you knew how, you didn't have the resources. LAES is kind of in between right now. It looks like to me it could, I don't know. This is a pretty wanked up. I was hoping it would break down, but who knows? You guys know my philosophy with LAES. I think long term it's going to be a huge company. But again, I have to wait for my point of interest because that's the way I do things. So I have to see how this plays out. A lot of interest there for sure. But I'm really looking at, because it's 23 minutes until the close with PLG. It's all about what you think's gonna happen with platinum. Because gold going up 190, platinum up 115. I mean, normally platinum was either level with gold or it was a little more expensive than gold because it was a little less, acquirable than gold, let's just say. It was a little more, little harder to acquire. Like, there was less of it. So platinum would usually be somewhere around a 1-to-1 or slightly above or just a little bit below. All of a sudden here, we're over a 2-to-1 differential. Cleanly over a 2-to-1 differential, which means the platinum gold ratio, if it even exists right now, has got to be out of whack. Which tells me that the platinum miners are actually a steal right now compared to gold. Just because of, well, I don't want to say compared to gold. I don't even know if you can do a gold platinum, or can you do a gold platinum like the gold silver? I don't even know if you can, to be honest with you. I don't think so. I can't even spell platinum right now. I keep spelling it like a plant. Of course, there's not gonna be anything like that. Thomas Goat sounds like it's playing catch up to gold. It seems like it. I appreciate that, Mark. I appreciate the kind words. I wish there was a ratio to play. I don't know why. I don't think there is one, to be honest. Somebody has to have it. Let's see. So multiple frequently updated charts exist for the gold/platinum ratio. XAU/XPT. Ooh, I didn't even think about that. Perfect. XAU XPT. Beautiful. Yeah, but how am I supposed to get this up here is the problem. Also, ratio symbol or manually enter the ratio. XAU XPT. Let's see, XAU XPT. Gold spot, platinum spot. Yeah, look at this. Oh boy. XAU/XPT. Okay, let's try that. XAU/XPT. I don't understand. Why isn't it showing it? This is the same problem I always seem to. Let's see. Unless I have to go XPT XAU, but I shouldn't have to do it like that. Nah, that's just a short volume. All right, I guess I'm gonna have to do it this way. I mean, look at where this chart historically is. It could be a bottoming. I don't know. We'll see. We'll definitely see. It looks like it's building out, though. No, I know, but for me, MQT, the decision is because I let some go when it was higher. Now it's like 11% lower than when I let it go. I kind of want to, I'm thinking I want to reinvest in those to see how this move goes. And it doesn't bother me if it goes down 10. I'm not worried about that. I'm trying to see this at, you know. Yeah, look at silver. Unbelievable. I really believe that we're probably setting up into something for tomorrow, it looks like. For the miners. Well, maybe not even the other miners. I mean, B2 Gold's doing phenomenal. But that PLG, that's the one that gets me intrigued because of the differential. We even had a wick down. And then you could play it back up, theoretically, into that $4, $4.15 range, maybe. One of my rules is buy resistance. Yep, I get that. It's just technically this setup, to me, if it can play out of it, this is exactly what you'd be looking for, a continuation. If it plays through. Obviously, there's the what ifs. But, you know, in life, there's always what ifs. You're always going to have what ifs. All right, let's look back at crypto. I'm going to have to go because we just got back home with my son, and I want to make sure I, do what I got to do here as a dad. What do you think, Mrs. Stott, before we leave? I'll be interested to hear. That's why I said with crypto, though. I mean, I wouldn't really do anything with crypto right now. We're in testing phase. I think XDC is still trying to let us in on some stuff. Did it end up getting to the bottom of that little chart? Not yet. Oof. That's the question. Silver all-time high on JM. Oh, yeah. Oh, it's a beautiful sight. You notice the silver miners haven't done dick today, though. Even B2 gold being up 3.89 is great, but I mean, it really didn't do anything for gold being up $200 today. It's crazy. That PLG is the one that is in my brain. When I log off here, I got 13 minutes to decide what I'm going to do. It's the one that says, Tom, if you're a gambler today, that's the way. But remember, it's a gamble at that because we had a resurgence. But that looks like a pretty decent 4-hourly candle to kind of give us a little bit of hope. The other thing that gives me hope is that this chart is starting to break out a little bit now. We'll see if it gets eaten up or not at the end of the week. Let's see the 7-day. What does it say? Bullish reversal, reliability high. Bearish reversal, reliability medium. Oh, yeah. It is a bullish reversal, but see what it doesn't tell you is when it goes down. So it was calling a reversal there, went down, consolidated, not made a V-shaped recovery on the ratio. See, the ratio is getting out of whack. The ratio at some point is going to come back to the medium. And look at this. We're at like historic lows here in the ratio. It's well, not historic lows, but it's been a long time since we were down here. Unless we plan on coming back down to the all-time low. That puts us way down here. I mean, it's not the all-time low. It's just when they started to chart it like this. It's pretty low, though. It's pretty low. That is pretty damn low. But anyhow, I got to go. Thank you all so much. It's been a pleasure, an honor, a privilege, and everything in between to go down this journey with each and every one of you. And, you know, if you own silver and gold bullion, congratulations. That's all I'm going to say. Congratulations. The miners can do their own thing, but the bullion themselves, if you own it and you understood what was coming, congratulations. Yes, there's opportunity in some of these, which can often lead to despair. But if this does play out, I mean, you're talking about a play out here. First area would be that 415, 4 to 415, 395 to 415. But if we broke through here, you're actually looking at a $5 plus target on this consolidation right now. If this is like a extended consolidation. Yes, good luck to all of you. God bless all of you. It's just been incredible. I don't think platinum is just going to sit out. And it's not that it's sitting out, because it's up almost 5% today. It's just that it had a nice consolidation, because look what happened. Platinum did a great job. It went from 2,900 all the way down to 2,500. Now it's recovered a little bit to 2,648, but it's still 300 plus, about $300 off the top. The difference between gold and silver and platinum, gold never had that big corrective at all. Silver did, but not as much. But silver went from 117 all the way down to 101, 102. Now back up. The only thing platinum hasn't done, platinum's like a day behind. All platinum needs to do is, I mean, I think it's going to come back up there. I think it's going to come back up there at some point. Now, is it going to be tomorrow? Is it going to be I don't know. But it feels like it's not just going to stay down here. If I had to guess, I would say platinum's getting ready to build that cup up, just like silver did. And gold didn't have to. Gold just going, the hell with this. We love Jerome Powell around these parts. That's what gold's telling us. So be blessed, everybody. I hope this assertion and assessment